Right. Good morning, traders. Welcome back to One Kapite 8. Aiman here. Okay, so looking at the S&P 500, so it's close a little bit below the 6,500 resistance level. However, the overall trend remains bullish, judging by the broader picture here. Also, both SME lines are now trending higher, lending the support to the index. I think sentiment a bit dented, mainly caused by the AI tech chip stock, which the market took a hit after news emerged that Alibaba is developing its own AI chip, right? So I think this is threatening to Nvidia's China rollout. Also, Fed announced that the key inflation gauge PCE, which align with the expectation, but remains elevated a little bit. Also, I think over the weekend, focus tilted to the trade policy uncertainty, renewed political pressure on the Fed, and also the seismic importance of this week's US employment data. So the all eyes are now on the next week's data flow to gauge the Fed's next move, right? So if you look at the China 850, well, on Monday's session, it is off slightly, but not. I think it's not a sharp sell off, I would say. So this is just a mild pullback. Well, I think it appears to be a slight pause within this uptrend momentum as makes manufacturing signals cause traders to step back a little bit, right? I think meanwhile, if you take a look at the Hong Kong market, we're stronger. Also, Alibaba stock jump on the AI cloud growth, lifting the Hang Seng over 2% ish, right? So I think overall sentiment remains positive for the on the tech and the policy optimism, but the A50 is pausing amid the data caution. Right, so looking at the WTI crude oil price futures, right? Well, it climbed, I think around 1% today to close at 64.69 US dollar, bought by elevated geopolitical driven supply concern, a weaker US dollar, and also robust demand sentiment. Well, I think at this juncture, technically, or is fitting within or with a breakout above the 50-day moving average. I think keeping a bullish bias afloat. Also, if you guys notice, right, Indian buying at variable pricing also added to the market support. Uh, I think over the week, there's no major, I would say, major drama. So the stage is set for opening mode. However, from the early of August, we have a negative trading bias since the chart is showing a steep downtrend. But for now, we keep our negative trading bias unchanged unless it went up and breached above the 67 US dollar stop loss level. Right. Looking back at Malaysia market, well, the FKLI retraced last Friday, easing about 14 points to close at 1548 points as investor sentiment turned cautious amid the mixed global cues like rate cuts, expectation, also contributed to the risk of positioning in the Malaysian equities. Well, the uh, the move appears to be a healthy pullback within this uptrend movement, possibly driven by the profit taking over the long term, I mean long holiday, right? Last weekend. So I think this one is just a pullback rather than a start of a new trend. So overall market tone remains neutral to optimistic ahead of fresh catalyst. right? Okay, so if you take a look at the trading perspective, right? So with the short-term ups and downs, maybe if I can move your attention here, uh, take a look at the tech index chart, right? So I think that the index has experienced a bullish breakout somewhere around here at 56 point level. Um, and maybe if you can capture around 5 to 10% upside from this tech counter, well, it is a good enough already, right? Also, if we were to look at the pending breakout sector, I think the best to watch closely is at consumer stocks. So if you look at the index here, it managed to cross, I think, to stay below this 490 point level. Well, keep your alarm on for these consumer names, right? Also, if you remember, all of us are entitled for the 100 ringgit cash aid that we have announced. So it can be used already. And so maybe this could be the short-term catalyst for the consumer stocks, right? Okay, so this is our watch list for today that you can take a look at. Right, so I think stay tuned for our Malaysia trading stocks for today, as we have yet to publish the report. Right, so for the FCPO, we saw a notable dip last Friday, falling around 1.6% to 380 ringgit per ton. So this slide was triggered by the weaker soybean oil prices, which also, I think, profit taking for a long weekend. As well as firmer ringgit, right? So I think seasonal production concern also came into play, but the overall, I mean, it's a correction, uh, not a support breakout. This is just a correction, right? So we still keep our bullish trading bias unchanged at this juncture, unless it break out below this 4,250 support level, right? I think that's all from me for today, and I pass the floor to Yishan. Happy trading, everyone.
Morning, everyone. Just a quick update from us. So we have published an Econs Weekly Review on last Friday. So for the upcoming weeks, so we do look up for the FFR cut for the September of 2025. So we think that the door is open for 25 basis point federal fund rate cut. So our key conviction is for 25 basis point rate cut in the upcoming September FOMC meeting, which will bring the Fed fund rate to a range of 4 to 4.25 from the current range of 4.25 to 4.5. So new cues from the Jackson Hole Symposium and the recent Fed speak are now indicating a heightened possibility of a US Fed fund rates cut in September. So specifically, Fed Chair Jerome Powell appears to have left the door open for interest rate cut, while voting member Christopher Waller cited his support for a rate cut in September, along with additional reductions over the next 3 to 6 months. So we are seeing that the risk-taking appetite has improved in the market. So our RHB risk sentiment index continues to rally further into the new week, reinforce our view on overweight equities, market weight fixed income, and underweight in cash. So we attribute the improved risk appetite to the increased probability of an FFR cut in September. So with markets clearly desensitized to tariff-related risk at this juncture, our last week view in citing pockets of risk aversion did not fully pan out. Risk assets, especially US equities, continue to rally amid a lower bond returns in the IG bonds space. So our initial view stemmed from our expectation that global investors will rotate into quality fixed income and safe haven assets. So given the escalation of US-India trade tension, a risk that global investors appear to have priced out swiftly. So on the other hand, we do expect the US 10-year yield to remain in the range of 4.1 to 4.42 for this week. So despite the Friday weakness due to a strong second quarter GDP and jobless claims data in US, so market continue to price in the 2 Fed cuts this year. So anchoring the 10-year yield, so with Fed Chair Powell opens to cuts if the labor market softens, the upcoming JLTS data will be key to reinforce those expectations. So spreadly, the dollar index appears poised to end its 3-week decline as market price in clarity over a FFR cut in September. However, stronger than expected US data on last week has shifted focus to whether the US Fed may slow or halt the easing after September. So for the coming week, so which is this week, so a strong PCE print could push the dollar index above the resistance level at 98.3, this which is the first resistance level. So targeting the 99.3, which is the second resistance level. So support will remain at 96.8 for support level 1 and 95.2 in support level 2. So we do expect that further monetary policy easing for this month, so which including a 25 basis point cut 25 basis point cut each by the US Fed and Bank of Canada, given their cautious stance and potential slowdown in high-frequency indicators in the second half in this year. So separately, we have downgraded Malaysia full-year inflation to 1.6% from our former estimates of 2%. So amid a softer than expected second half inflation, so expected, driven by mild policy impact, including lower RON 95 prices, limited cost pass-through from SSA expansion, and electricity tariff and subdued demand pressures. So on the Malaysia end, so despite the external risks, so we expect the OPR to remain at 2.75% in the 4th of September MPC meeting. So despite all those external risks from the trade end, so we do see that Malaysia's domestic demand remain resilient, supported by a strong labor market policy measures and also sustained investment from infrastructure development initiative. So for this week, we are looking for some key data out from the US, which including ISM, manufacturing PMI on 2nd September, JLT data, which is on 3rd September, factory orders, and also NFP data, which is on 5th September. So in ASEAN, we do look out for Indonesia August inflation and also Singapore retail sales data for this week as well. So that's all from me. I'll pass the line to the next presenter. Thank you.
Okay, thanks, Sian. So for this morning, I have the CIMB results note. Second quarter results, this was broadly in line with our as well as our consensus expectations. They reported net profit of 1.9 billion ringgit. This was down 4% Q on Q and also down 4% year on year, bringing the first half 25 earnings to 3.9 billion ringgit. Slightly lower year on year, but made up about 49% of our and consensus FY25 earnings. Reported ROE 11.1%. This was very much in line with the 11 to 11.5% ROE target. And they declared a interim DPS of 19.75 cent, which is 55.5% payout ratio. Also, quite in line with what they are guiding for. The results highlight, so the weaker sequential net profit was due to a higher effective tax rate, where if we look at in the past, that tends to be higher in the second quarter, and then it tapers off subsequently in the subsequent quarters. While year on year, the drop in net profit was due to lower recoveries and write-backs. But again, CIMB, because of its regional presence, forex impact was also a bit larger for the group, especially Indonesia and the Indonesian rupiah. If you look at just the Malaysia operations, this actually did well with PBT up 12% Q on Q and 8% year on year. This came from slight margin uptick as well as asset quality holding very steady. If you look across the numbers, loan growth was still a bit muted, partly due to FX impact. And also, wholesale banking was a bit soft. Margins was down about 1 basis point due to Thailand as well as Indonesia, but Malaysia and Singapore margins actually expanded sequentially. Balance sheet still very much solid. The balance sheet is liquid with the loan to deposit ratio at 89%. Again, capital levels are really sound, and asset quality was actually stable with the loan loss coverage at slightly above 100%. Some briefing highlights here. So, because of July's OPR cut, management has actually lowered the margin guidance to 5 to 8 basis points margin squeeze. This is from 5 up to 5 bips compression previously. And, They are trying very hard to manage the funding costs, but because of the July's OPR cut and in Singapore, what's happening in Singapore, they guided for third quarter to see some margin squeeze in Malaysia as well as Singapore, and that should lead to some overall margin squeeze at the group level as well. The other targets really unchanged. The loan pipeline is healthy and robust, just waiting for drawdowns, and management thinks that once confidence improves, now that there's better clarity on US tariffs, that drawdown should actually come in. There's also some optimism on Indonesia's tight liquidity situation that that is improving, and that should help with net interest income growth in the second half. We have actually trimmed our net profit forecast FY25 to 27 by about 2% each year. This was on lower NIM assumed, given that the revised guidance from management. But the impact to target price is actually not material. Hence, we keep our 8 ringgit 40-cent target price, and we are also keeping our buy call on the stock. So really among the big cap banks, this is still the cheapest bank. Dividend yields 5% is also very decent, and really, I think once on the regional side, like especially Indonesia, when the tight liquidity situation improves, the rupiah stabilizes, Indonesia should actually contribute. The momentum from Indonesia should actually improve quite meaningfully. Okay, so maintain buy on CIMB with a 8 ringgit 40-cent target price. Okay, I'll pass you to the next speaker.
Hi, morning everyone. Let me continue with an update note on 99 Speedmart. So essentially, we found out that 99 Speedmart has extended its footprint into China by opening its first outlet in Fuzhou, Fujian on 31st August. We are not entirely surprised by the move, as if you have read the second quarter result announcement, they did highlight or outline their vision to expand the business beyond domestic borders and has been exploring various regional and international opportunities. Whilst we are positive on the venture as a step forward to foster and sustain its longer-term earnings growth, we remain well cognizant of the execution risks and challenges in the competitive China market. Not much details that we have managed to obtain, but we understand that the China operation will be wholly owned by 99 Speedmart, the listed co. No specific store opening target has been set. With the pace of expansion will depend on the performance of the first few stores, and hence we expect the initial capex and earnings impact to be minimal until the expansion pace is accelerated. Balance sheet is more than sturdy enough, 836 million net cash as of second quarter to support the expansion, and we make no changes to our earnings forecast at this juncture, pending more detail on this venture. And what does it mean to 99 Speedmart? I think based on our quick checks, there were no prominent or major mini market chain players identified in the province of Fujian, and this could indicate that the industry is currently being not dominated by the independent or mom and pop players, and or the consumer preference is to shop for their grocery with the larger scale supermarkets, which means this obviously will offer a huge opportunity for 99 Speedmart, given firstly the huge population of more than 40 million just in Fujian alone. So if 99 Speedmart were to replicate its success in China or Fujian by either consolidating the industry or driving a favorable switch in consumer preference there, like what they did in Malaysia, they will be able to find their second leg of growth, and it will be a very sizable one. That said, it remains to be seen how 99 can commit to its ethos of near and safe, as it may not be able to leverage much on its existing scale of operations here in Malaysia to secure competitive unit costs, as grocery products are typically sourced locally. So no changes made to our target price. We continue to like the company as a major proxy to capture the resilient consumer spending in Malaysia. Maintained buy target price remains at 2 ringgit 81 cent. Let me stop here and pass to the next speaker. Thank you.
Okay, good morning. We have a results review note on Telekom Malaysia TM. This is the first half numbers or second quarter 25. If you look at the overall numbers for the quarter, distorted by Forex and one-offs, all non-cash in nature, and also staff cost reversal. So if you look at the first half numbers, core PATAMI is at 837 million. Minus 2% on year-on-year basis. It's at 48% on forecast, consensus 50%. Sequential EBIT grew about 16.5%. That's driven by lower direct costs and depreciation. Some assets already approaching the end of their useful lives. First half EBIT minus 5.8% year-on-year. That's tracking slightly below guidance, but they do expect a stronger second half across all segments. So that's consumer, wholesale, enterprise, as well as the the public service one, TM1. They have actually maintained a guidance overall for FY25. I also want to point out that balance sheet has improved considerably. In July in itself, which is post second quarter, they've repaid about $240 million in debt. That's the bonds that they're holding within the Listco itself. I think basically clearing up the debt in terms of the overall bonds or debentures they have in the balance sheet. So if you look at that particular tranche of borrowings, it's 7.8% interest rates. If you look at the repayment, the potential annual interest savings come up to the range of about 7 to 75 million. So quite substantial there, and you see this flowing through the bottom line in the second half of this year. So assuming that they've repaid the whole chunk there, net gearing is set to improve further to 0.2 from 0.3. So if you look at the fixed line business, still generating very pretty healthy cash flows, and that sort of balance sheet is something to be very respectful of, obviously, and it also portends potentially higher dividends to shareholders. Operationally, I think numbers are still quite okay. No reason to be overly concerned about at this point. Due to that bit soft in terms of EBIT, I think the EBIT growth will come back in the second half of the year. Also, I want to point out that OPEX numbers are actually well managed. They've done some restructuring in terms of the staff last year, so the follow-through impact of this it's basically seen this year. So the staff costs have come down on a year-on-year basis. Also, the data center business, obviously there were some questions there. The call, they've got 2 new expanded capacities coming up. That's the twin core DCs over in Iskandar Putri in Johor, and the one in Cyberjaya KB DC. I think if you look at the expanded capacities, both combined will have additional 20 megawatts. I think both probably will come on stream by the end of this year, fourth quarter to be specific. And with the expanded capacity, they will basically be driving stronger growth into the future as well. They did say that they're probably going to start the Iskandar Putri site pretty soon. The KVDC site, it's due for completion. Probably sometime in December or even January of 26. They don't disclose the numbers from the DC, obviously, but still fairly small. At this point in time, it's actually booked under the wholesale business and TM1. But we expect the growth to be fairly strong because of the expanded capacity. Also, the JV with Singtel on Nextra, the advanced artificial intelligence DC, which is coming up. They're indicating a timeline of sometime mid-2026 for commencement. It may slip slightly into the third quarter or even fourth quarter, but overall, I think still very much okay in terms of the timeline. That DCs, they've said that the funnel of interest, it's pretty strong. Obviously, it has the backing of Singtel, so I think they'll be in a position to pre-sale some capacities ahead of the launch next year. Overall, no change in terms of sector view, rather stock view as well. We're maintaining a buy call, target price at 8.15. If you look at the dividends, this quarter, this is the first interim dividend. They've declared 12.5 cents. That's already 60% payout, which is at the higher end of their 40 to 60% guidance. So keeping our buy call, target price at 8.15, gives rise to about 4% dividend yield at the current point. Okay, I think that's all from me for today, and I'll see you again.